Crown Castle stock, ticker symbol CCI. This stock was requested by Joao Mendes. So thanks for the request. Let's analyze this REIT. Crown Castle is down 8% year to date. And that's pretty interesting to start with, since as you can see here, REITs had a decent run lately. But still, CCI stock is down on the year to date chart. And one of the main reasons why people like Crown Castle is because of the 5.7% dividend yields. On top of that, they have been growing their dividend for 9 years in a row. So the big question for today is Crown Castle stock a buy at current prices? Let's dive into the recent earnings report and do a fundamental analysis. By the end of the video, I will show you the 3 price targets. On the 16th of October, Crown Castle presented their earnings where they beat on revenue but missed on FFO. And for the upcoming earnings, analysts are quite pessimistic. Looking at the earnings insights, we see that rental revenue increased 1%, which doesn't look too exciting to be honest. This is also probably why investors, but also the analysts, are a bit more pessimistic. Growth isn't really there. EBITDA is growing 3% year over year, also not exciting. But at least it is growing at a higher pace than the revenue. It's the same with the AFFO, one of the more important numbers with REITs. It's growing 4% year over year. For the full year of 2024, it is not looking any good since they expect revenue to decrease year over year at minus 3%. For the EBITDA, they expect a minus 6% year over year growth. And for the AFFO, a minus 8% year over year growth. Crown Castle said in their earnings presentations that they delivered a solid third quarter, with 4.5% tower organic growth and 10% small cell organic growth as well. The fiber solution segment grew 2%. But still, I'm not buying it, since the growth in revenue, EBITDA and AFFO isn't really there. However, there are also some good things about the recent quarter. Net income is growing at 14%, which is a start. And the AFFO per share is reported at $1.84, which covers the $1.57 dividend. So that's looking pretty good to me. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Crown Castle is a 46.5 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at 15.5, indicating they might be undervalued. Later in this video I will show you my 3 price targets for Crown Castle stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 6.6 billion and in this graph we see that revenue went up in the long run. However, in the recent years the revenue is declining. This is also something that is expected in the upcoming quarters by the company itself. So definitely keep an eye on this number. And with revenue declining, it is really important that margins are increasing. And that is exactly happening with the 3 most important margins to me. So this is looking really good. Looking at the EBITDA margin, we see that this number is increasing ever since 2018. But most recently, it is going down. So you want to keep an eye on this number as well. EPS is going up in the long run. It is not always steady and consistent, but that's very common for REITs. Analysis expected in the coming years EPS will increase to $3, but it is going to be a bumpy ride from here. For the revenue, it is a similar story with an expected 7.5 billion in revenue in 2028. But 2024 and 2025 are showing a real slowdown in revenue growth. Return on assets is sitting at 3%, which is low for a REIT. Return on equity is looking great at 21%. And the most important number, return on invested capital, is sitting at 6%, which is again a decent number. And it is also slightly higher versus the 5-year average, so that's also very nice. Current ratio is at 0.54, which is a little bit too low in my opinion. This is something to keep your eye on. But for now, it doesn't concern me too much. And right now, Crown Castle has 30 billion in debt. And I prefer companies that can pay down at least a big chunk of their total debt with the total cash. CCI has 194 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and a lot of things. And here we see that free cash flow is going up in the long run, which is a great thing. For a REIT this looks pretty good. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at almost 5.75%, which is a great number. Annual payout is at $6.26 and payout ratio is at 85% based on the AFFO in the recent earnings presentations, and not the 94% displayed here, which is still a bit above the 75% average for REITs. The 5-year growth rate is sitting at almost 7%, which is a great number, and they have been increasing the dividends for 9 years in a row now. In here we see the dividend growth in the past 10 years. It is looking pretty steady and consistent, and even during the lockdown periods they managed to increase their dividends. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at a low rate from here. And overall these dividends look pretty good to me, but how about the historical returns? I decided to compare Crown Castle stock with the overall market, in this case the S&P 500. On the 5-year chart we see that CCI had a minus 6% return, which is really sad to see, especially since the S&P 500 returned nearly 108%. And this result is including dividends. Historically, it doesn't look too bad for CCI, but ever since late 2022, it went wrong in terms of total return. On the 1-year chart, it doesn't look good either for CCI, with a 26% return versus a 42% return for the S&P 500. However, on the 6-month chart, it is finally Crown Castle beating the S&P 500, also driven by the REIT bull run in this period. On the 1-month chart, it is again looking pretty sad for CCI, with a minus 8.5% return versus a 2% return for the S&P 500. So bottom line, Crown Castle underperformed the S&P 500 in the long run, but also in the short run. So could this be the perfect time to buy CCI stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 2, 4 and 6%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 17, 18 and 19%. And for the free cash flow margin I'm putting in 21, 22 and 23%. For the P/E ratio I'm putting in 20 and for the price of free cash flow I'm putting in 20, 22 and 24. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Crown Castle stock is around $107. I hit analyze, and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $42, we have a mid price target of $54, and we have a high price target of $70. To me, the mid to high price target is the most justified here, indicating that this stock is overvalued right now. Which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on CCI stock is that even with some pretty high assumptions, the stock is looking overvalued. And the problem really lies in the current growth. They have an interesting niche, that's not the problem. The problem is the current revenue growth and also the AFFO growth. From a dividend point of view, things look really good with a high dividend yield and also decent growth stats. Most fundamentals look pretty good as well, besides the growth again. For now, I'm skipping this stock, since it is not looking that interesting right now. But I keep my eye on the company and analyze them from time to time, since the niche is very interesting. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you like this company and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.